Hello, everyone. Welcome to the weekly roundup. Today we will cover tariffs, global economy, and market sentiments. Hello, Ben.
Hi, Eva.
Dressed for the weather.
Sweater season. I broke out the sweaters yesterday.
Come on, we just had a nice weekend.
I know. I know. It's sad.
It's over already.
It is.
We'll survive.
I hope so.
Okay, so let's get into it. We're starting off with tariffs. I know
Mhm.
that the Canadian Prime Minister Mark Carney and US President Donald Trump met earlier this week to discuss tariffs. Now, did anything concrete come out of these talks, or are we still in the holding pattern?
So it's a great question. I think the answer is I haven't seen anything concrete yet come out of it. But the USMCA or NAFTA, as most people still remember it, ends up covering a lot of what our economy produces and sends out and ships. And so, you know, on average across all of the industries that we produce it and send and stuff to the US, I mean, products and services to the US results in about a 5% tariff right now. So I know some of the areas like steel and lumber and milk and things like that will be hot buttons because they have huge tariffs on them right now. And so I think we're looking for a solution to come out of that, and likely there will be one.
Yeah.
If you look at the deals that he's put in place around the world, President Trump, they've all been better than they were. So I think there'll be a positive that comes out. Always good for them to meet, but as we can never fully trust what the outcome's going to be. But generally speaking, I'd say all positive so far.
Okay.
Yep.
Okay. Fingers crossed. Um, so let's move on to Europe. I mean, with France's new prime minister and government stepping down in like 2 seconds, what ripple effects could this have on the French economy and the European markets? Are there any risks and opportunities investors should keep an eye on?
So great question. Something I learned this week is that as soon as you're named prime minister in France, you immediately receive a pension for life. So
Oh,
16 days in office and pension for life. I
not a
think
bad deal.
we're
I'll
doing the
take
wrong
it.
thing. They also get a driver and a limo for the rest of their life as well. Yeah, no, joking aside, it is a bit of a mess, certainly in France, and the bond market has reacted negatively in France, and so yields have gone up with a bit of a concern for what the outcome might be. Some people think Macron steps down because of this. I don't think that's the case, because he's the only one that's providing stability to France right now, love him or hate him. So I don't think that's the case. He did announce a new prime minister. I think today I don't know anything about them, but he did announce that. Um, Opportunity, I think, probably are in the bond market because I don't think this will have a ripple effect on the rest of the country. Naming somebody new, ultimately, they probably get some kind of conservative type leadership in there, and you probably get some fiscal restraint, likely. And the ECB keeps cutting rates too, so that's a positive. If you get those two things happening together, should be good for France. So I'd say generally positive from here. The uncertainty, though, obviously still continues to be high. From an opportunity set, if you look at valuations, US is at pretty high valuations, say 23 times earnings. Canada is about 17, which is below, but still in the higher end of the range. Emerging markets has actually moved up into the higher end of the range. And Europe is actually trading at probably the best valuations right now, 12 to 14 times earnings, we'll say. There's probably still opportunity to make money in Europe right now as a result of it.
Okay. Speaking on valuations, October has seen record highs, both in the US and the Canadian equities markets, mostly I think led by tech and gold stocks.
Hmm.
I'm gonna ask this for probably the 100th time. What is happening and what should investors focus on?
Yeah, so I think let's take those two that you say, gold and tech stocks. So maybe tech stocks we can take a little bit more context because people probably understand that a little bit more because of we've gone through a number of cycles where we've had big rallies, particularly in the US. We had a big rally in tech in 97, 98, 99, and we had this big run up in tech. And there's some similarities to that. There's a number of businesses that are just coming out with ideas and such. It's a little bit more mature now because a lot of the tech companies that come to market, like Circle or Figma, like some of the recent big tech IPOs, these are established businesses that are making money already. So it's not quite the same as the tech heyday, where a lot of these companies launched just with ideas and they were a big market darlings. Where right now, private equity launches into IPO tends to be a business that makes money already, and so that's a little bit different. But as for the momentum associated, as you say, with Nvidia and Amazon and Apple and Tesla and these names, I think it's really money flow that continues to drive that narrative. And so as you look at new money coming into the stock market in the US, 100% of the new money comes from 401ks, IRAs, like pension plan type investments, and new money into IRAs and 401ks. Majority of that money is going into Vanguard and BlackRock, and Vanguard and BlackRock are passive ETFs, and so passive ETFs buy the index and push up the valuations. So that's money supply flows, all of that, I think, is what's driving it. And valuations are, will matter at some point, but are pretty irrelevant today. On the gold and gold metals and gold metal companies side of things, gold's been driven. You can argue why, but I think a lot of it has to do with the uncertainty around the US dollar and what President Trump might do. And so if you look at what's happened, all of the central banks around the world have been buying gold in lieu of US dollar this year. And usually you have those things happen together. But you've seen central banks been big buyers. And so that's where you've got a big bid in gold. That reverses quite quickly at some points. But right now, that has been the big buyer of gold. And as a result of that, you've seen the mining stocks go up 100% or so this year. And again, just like anything, and a little bit cliche, but markets go up on an escalator and go down on an elevator. So these are the types of things we need to be conscious of. And
Yeah,
so, we've taken some profits on gold and gold miners in the past week and a half, and we'll continue to do so because no asset class should go up 100% in a 6-month period of time.
I agree. Okay, let's see the charts.
All right. All set.
Oh,
Okay.
good.
Okay, perfect. So we are recording this around 1 o'clock on October 9th. So anything that happens between now and then, we can talk about next week. So this is, of course, Thanksgiving weekend in Canada as well. So we'll talk about that when the markets are open and such as we wrap this up. But the opinions expressed do not necessarily reflect those of National Bank Financial, as you all know. So a couple things. I always like to look at a number of different slides, and I like everything from technicals to fundamentals to Elliott wave theory to sentiment, and this was a technical chart. And so as I look for and continue to look for where are the potential opportunities, this was one that grabbed my attention, which is natural gas. And so this is from our technical team. And so there's a whole department within National Bank Financial that does analysis, technical analysis. And so this was a great chart because natural gas has been kind of trending lower This is a newish chart. So this is at the end of last year, early this year. And so we've had a bit of a downward trend in some of the natural gas stocks. And now we're starting to see natural gas start to break out to the upside. So, I wouldn't necessarily buy this per se. You can buy UNG, which is an ETF that tracks on a rolling 30-day basis. But it makes me say maybe there's an opportunity in some of the natural gas stocks that haven't participated, particularly as we start to head towards fall and winter, as we start to head towards more energy being needed for AI and technology. And we're starting to see this start to break out. So great signal to say maybe some of the natural gas stocks that haven't done super well are worth considering in adding into the portfolio. So this is US data. So this comes from our partners at ISI Evercore. And so we would be looking at a number of things, but one of the things that we look at with US is, there's been a fear of us being in a recession, or us, I say the US, being in a recession. And so some of the softer data points that I think are interesting to look at is restaurant visits and retailers. And so how much are people spending more? Are they going out more? Or are they staying at home? And so we've been on a downward trend into this year. So this has been retailers. And so we've seen a nice, pretty material uptick here. So people are going out, people are spending money. Some of this uptick has been school related, and it was quite a strong back to school purchasing season. So that's a positive out of the US, which kind of runs counter to what you may hear in some of the media and news. And the other is restaurant surveys. So we've been on a downward trend as well for a couple of years. And so now we've seen an uptick in restaurant sales, and this would be the surveys themselves would be saying that activity is picking up, people are coming back, people are spending money. So again, runs kind of counter to the fear that maybe we're heading into a recession. And this chart really signifies this next one. This is US consumer net worth. And this one signifies the fact that people are feeling a bit more confident. People are feeling like they have a bit more money. So this would be their 401ks, their IRAs, their investment accounts, their homes, their second homes. So because the majority of those things have been going up, people are feeling more confident. They'll go out to retail, spend money. They'll go out to restaurants and eat more. And this has all been lifted on the back of higher valuations in most things. Real estate's been fairly stagnant, depending where you were. But from a market perspective, we've been in an upward trend. So net worth has been rising. So the U.S. consumer has been feeling better. At the same time, we've had financial conditions start to get a bit better with rate cuts and the likelihood of future rate cuts on the horizon. On the back of this, if you look at what President Trump has been doing, the tariffs, whether you like them or not, seem to be generating additional revenue into the US. That's a positive. They plan to spend significant amount of money over the next, we'll say, 36 months. And that will be going towards manufacturing, industrial. So there'll be a lot of money coming back into the system. So generally some positive sentiment shifts happening in the US, and thought these were great charts to think about what that means for the consumer, because the US consumer is something like 70% of GDP. So as always, the opinions expressed do not necessarily reflect those National Bank Financial. If you have any questions, certainly speak with myself or your advisor. Everyone's risk tolerance is different and unique, so please consider that when you're making your investment decisions.
Oh,
That's it for
carry
today.
on. Good. So what's on the agenda for next week aside, Thanksgiving turkey?
Yes, so the Canadian market is closed on Monday. So, but as for what's to look for next week, one of the questions you asked about is gold and miners. So we're seeing a bit of a correction today in gold. So I'll be curious to see if that 4,000 level holds on gold. So I'll be watching that and seeing the impacts on the miners. And we're heading towards the probability of rate cuts. So we in the October 29th meetings for both Canada and the US. they'd be discussing whether they cut rates or not. So any signals that could influence that one way or another, and continue to look for opportunities where we can take profits and add to other investments because we've had a pretty nice run up in a lot of things. And I continue to do my homework around where the stock opportunities are. So some potential shifts. October, again, historically has been a volatile month like September was supposed to be. So if there's any signal that tells me that we should change course, then I'd be looking for that. The last one, Eva, as people always ask is, what's the one thing I should watch right now? And I'd say the one thing would be the US dollar right now. So
Okay.
we've seen a slight uptick in US dollar and downtick in gold. So if that trend continues, then I think we should be cautious.
Okay. Sounds good. Thank you, Ben.
You're welcome.
Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video, as well as in your email box if you're subscribed. For our clients, please reach out to me if you have any questions or if you'd like to schedule a review meeting with Ben. Thank you for listening and have a great Thanksgiving weekend. Bye.
Thanks, everybody. Take care.